folks. I'm Sam Chandan, the Larry and Clara Silverstein Chair and Dean of the Schack Institute of Real Estate at the NYU School of Professional Studies. Thank you so much for joining us for this week's edition of the Capital Markets Leadership Series. This is a companion series to the REIT Leadership Series every Tuesday at 12:30 Eastern. We're joined by a different REIT CEO, chairman, or board member. We kicked that off with Sam Zell on July 8th. And have just had a sort of a fantastic sort of your group of colleagues and friends that have joined us in the weeks following, including just this Tuesday, Jay Brown, CEO of Crown Castle, telling us about the world of data and cell tower real estate investment trusts, which was just sort of amazing to hear about, certainly outside the scope of what we would think of as historically core commercial real estate assets. We're going to take a break next week for Thanksgiving, and then we'll reconvene. And in the final weeks of the semester, we'll be joined by Chris Lee from KKR, Miriam Wheeler from Goldman Sachs, and then finally winding out the semester and calendar year by Lisa Pendergast, CEO of the Commercial Real Estate Finance Council, will tell us about what some of CREFC's and the industry's priorities in engaging with Washington will be as the new administration steps in late January. As a reminder, this series is sponsored by Arbor Realty Trust, and we're grateful to the team at Arbor. The funds that have been provided by Arbor and sponsors of our other programs this summer and fall have been critical for us in continuing to support students with merit scholarships and importantly, really more than ever, need-based financial aid programs for those students whose finances may have been impacted by the pandemic. In addition to Arbor, the series is sponsored by our association partner, the Commercial Real Estate Finance Council. And of course, earlier this year, CREFC and Schack co-established the CREFC Center for Real Estate Finance, which has just been a huge blessing for all of us at Schack. And for our students, for faculty. We have a very ambitious agenda for the coming year in terms of the kinds of research work that we'll be doing in support of our colleagues and professionals in the debt market. Please do use the Q&A feature as we go through today's conversation. I'll be keeping an eye on that, and remember that, of course, that all of our recordings, with just a few exceptions, are available on Schack's YouTube site. That is youtube.com/NYU Schack. Just an amazing wealth of content, including replays now from last week's 53rd annual conference on capital markets and real estate. We made sure to persevere with that. That conference was established by Larry Silverstein in 1967, the same year that he founded the Schack Institute. And we actually, although online, this year we had our most ambitious agenda in 53 years, about 55 speakers, almost 2,000 people participating in the conference, really covering everything from the experience of Black professionals in raising capital at their own emerging manager funds, for investment in historically underserved neighborhoods, to just an amazing panel on alternative sources of finance that Michael generously gave his time to participate in, and that was moderated by my friend and colleague Marty Berger, CEO of Silverstein Properties. So please take a look at all of those, and perhaps amongst the most significant of the things that we posted as part of that series, a couple of one-on-ones. One with Jeff DeBoer, the CEO of the Real Estate Roundtable, where Jeff discussed again the policy priorities for the industry and engaging with Washington as the new administration comes in. His own thoughts on how orderly the transition to a new administration will be over the course of the next couple of weeks. Also, a one-on-one with Pat Foy, the chairman of the MTA, talking about the needs of the MTA's needs in keeping the subway, the light rail system, the buses running in a way that every New Yorker has come to expect, and how important that is for the continued strength and recovery of New York City. And then finally, opening comments from Larry Silverstein, some quick update on what's going on at Schack, but then the strongest and most compelling case I have heard from anyone yet on why the naysayers in New York's rebound and recovery are wrong this time, just as they have been wrong every time before. So please take a look at the YouTube site for all of that. Without further ado, my great pleasure to welcome my colleague and friend Michael May, president of Silverstein Capital Partners. Michael, thank you so much for doing this with us.
It's my pleasure, Sam. Thanks for inviting me for this. This is a real treat.
So, if we look at the list of folks that have joined us and their different firms, Silverstein Capital Partners is kind of the new kid on the block. So tell us a little bit about the nascence of the firm, how you and the team at Silverstein, really, decided to move forward with this. Where did you get your start here?
So over my career, I've tried to operate in spaces where other people aren't, that are still attractive. And so when you see people move out of different flows of capital for often regulatory reasons or other reasons, it can be an opportunity to step in and backfill that space with talented people in the private side. So my last company that we started, the CMBS market was in disarray due to Dodd-Frank and a bunch of regulations related to the great financial crisis. So we created a CMBS lender, in 2011, and became one of the top three as a private company within 2 or 3 years. So real opportunity. That market came back and compressed and became much more competitive, and the opportunity decreased, but it was a compelling opportunity. What I saw in coming to Silverstein was a similar opportunity. As you looked at the regulations in terms of where banks could operate, the leverage they could provide, and the complexity of loans that they could do, the ability to do construction lending was dramatically reduced. As private lenders stepped into the space for lending on construction, they were often very sophisticated financial players, but didn't have the wherewithal, didn't have the infrastructure to actually handle problems on a construction level. And to really, I thought, understand and even have the team to help me understand in a lot of cases what the risks of these projects are. So when you look at a company like Silverstein that's built the World Trade Center, for them to do a $500 million mixed use project is no big deal. If I was at a private capital source and I had money and sophisticated financial models, but no development team, I'd have a really tough time understanding if the assumptions I was making were right. So the combination of Silverstein wanting to branch out and looking at the market kind of holistically, Marty Berger, our CEO, saying, wow, pricing's really getting kind of high right now. Maybe we'd be better off at a different leverage point. Markets were so efficient that in a bizarre way, the pricing on equity, it required these gigantic jumps in really kind of aggressive assumptions, jumps in rents, jumps in decreases in cap rates, other things. And if you looked at just the cash on cash returns of the debt on buildings, it significantly exceeded the cash on cash of investing in buildings, right? So I had a partner, and Marty and I have known each other for 20 years. Marty, our CEO, and I met when he was at Related, I was at Credit Suisse. He was building the Time Warner Center. Credit Suisse had never done a construction loan, so I thought that seemed like an easy one to start with. The two of us spent a year negotiating it, and we've been very, very close friends for the 20 years since. So I jumped at an opportunity to come work with a friend, but from a personal and business standpoint, I thought, wow, this is a great infrastructure, a great organization, spectacular reputation, real tailwind in dealing with counterparties. And they've got an expertise, the secret sauce, I call it, of understanding construction and being able to look at complex projects, complex capital stacks, and have the team that would surround me that was already in place to do that underwriting and go compete. And then when you thought about even myself, be it a Credit Suisse, wherever, I thought about myself, 15 years earlier, and I was making assumptions on what a building cost or what trades cost or where things were happening in the construction environment or transitional environment. I'd take my best guess and I'd call a consultant. I'd get a call back a couple of days, or maybe a guy in Cleveland about what's going on in New York. And he'd look at something, 6 months ago, and that would be his information. At Silverstein, one of the first deals we did was a $235 million mezz on a 1,000-foot tall tower in Brooklyn. And when I looked at the cost of the construction, it was $52 for steel for the building. And I don't know why, I thought that seemed like the wrong price. So I walked down the hall and I said, hey, to one of the guys, Dave Borze, I said, what's the right price for steel on a 1,000-foot tall building in New York City? And he said, well, actually, we're bidding out two right now. One's 54, one's 50, 52 seems like the perfect price, go back. So that was a 10-minute, it took me 5 minutes to walk there, 3 minutes to chat, 2 minutes to ask the question, a couple of minutes to get back. 10 minutes, I had the perfect answer with two bids that were real time. Whereas otherwise I would have done my best to guess and I probably would have been wrong. So I had a great team, great infrastructure, a space that we had the secret sauce, and a place where the banks and some of the traditional lenders just weren't lending as aggressively. And then many of the folks that were in the mortgage REITs or the other private capital sources, other alternative lenders, just didn't have the construction and kind of development expertise to really to assess the risk properly. Not to say that some of them weren't doing it, and not to say that some of them don't. And we have other folks that are like us, like a Brookfield, that builds lots of stuff and they can do it. But by and large, most of the other lenders are more sophisticated from a capital perspective than they are from the nuts and bolts construction perspective. So from my perspective, the opportunity was huge. The construction boom was happening. Our sophistication was incredible, and the market was strong. And I was going to work with people that I really like to work with in an organization with just an A+ reputation. So I jumped on the opportunity and was really excited about it.
Fantastic. Most of the folks on our webinars are our colleagues in industry, but we also do have a number of students from programs around the country and a number of young professionals that may not have been in the industry during the financial crisis in the immediate aftermath. Can you just elaborate on one, I think, critically important point you raised with regard to changes in the regulatory and supervisory environment? Given the nature of the financial crisis, we see significantly greater interventions in terms of the regulation of balance sheet lenders in the market. Tell us a little bit about that and the opportunity that essentially created for a firm like yours.
Sure. So I'm going to go back. And first of all, I'm going to give the regulators credit because what they were trying to accomplish was accomplished. And I think one of the reasons why the banks and the financial institutions are getting through COVID is a result of the decisions they made in 2008. So we're 2020. So 12 years ago, those decisions are paying fruit, and that the balance sheets of banks are strong. The lending parameters they have are good. The assets they have in their books are generally performing. There's, of course, there are hotels and other things, some retail, but in general, the balance sheets of banks is infinitely stronger than it was before. Lehman was 30 times levered. Bear Stearns, I think, was 30 or 40 times levered. These banks were literally operating on the edge. And now, the government's gone to them and said, hey, listen, you're going to administer our PPP programs. You have enough essentially spare our PPP programs. You have enough spare kind of powder and energy to go help us be the solution versus actually being the problem. So let's start there. But what happened is after the great financial crisis, the government, through a series of regulations, said, we're going to clamp down on what banks do. And we're going to clamp down on how much you lend. And there are a couple of toggles, and I won't get too technical, but the one toggle that always happens is accounting. And there was Basel I, and then when I was at Credit Suisse, there was Basel II, then there was Basel III, and I'm sure there will be a Basel IV. And they never get better for you as a regulated institution. That's one thing I can promise. And then the second thing is and what those regulations, the Basels, what they basically do is they say, how do you account for risk? And what they do is they say you have to hold $1 of capital against a certain amount of risk. And then they said, what's risk? And so for a while, it was kind of like you held $1 worth of capital against anything. Then it was like you held $1 worth of capital against senior loans, but $10 against mezz loans. And then it was like you hold $1 worth of capital against seniors and 50% against a senior against a mezz loan, and then became 100%. And by the time it was done, literally some CMBS products, if you bought 10 million of bonds, you had to hold 50 million of cash against the 10 million of bonds because they set it up just to make it so prohibitive and so costly for banks that they just wouldn't do it. They didn't say you can't do it. That probably isn't legal. But they said, we're going to regulate it in a way that it just makes no sense. So bonds got out for accounting reasons from a lot of businesses. And then the other thing that happened is a bunch of regulations came in that just says you have to, for example, at a bank, somebody at the bank has to personally, if you sell loans in a securitization, somebody has to personally guarantee that if there's misstatements or problems, that you personally are liable for all those misstatements for your entire bank. So that's not a fun position to be in. And whoever actually is unfortunate enough to sign those things, I promise you made the bank do a bunch of things to make sure that they were right. So a bunch of these regulations came in, and also something risk retention. You have to hold on to pieces of loans. It used to be buy a loan, you'd sell it if you were in the securitization or moving business. Now you buy it, you have to hold on to 5 or 10% of the loan. So all these things are changes. The interesting thing about the way the regulation works is financial crisis started in 2008. By the time they drafted Dodd-Frank, it was 2011. 2-year comment period is 2013. And then the comments come back. Or I'm sorry, 2 years to draft the regulation. They passed the law, then the agency have to draft it. So 13. Now you have your comment period, it's 14, and then you have some redrafting, so it's 15. So by the time the stuff actually was implemented, it's 2016. It sounds crazy, 2008 problem, 2016 implementation. But when you see the kind of some shifts in the CMBS market and you see the shifts from banks, it was a result of that. And it literally took that 8 or 10 years before they were kind of forced to operate in these tighter environments. And so what's the result of it? The result is that the traditional kind of construction lenders, commercial banks, investment banks, instead of lending on the loans, they either did very senior, they went from 75% leverage to 40% leverage. Okay, it's great for the financial institution. Or what they did, which is I think great for people like me and good for liquidity, and what the regulators also I think wanted, is they said, look, we'll let you lend to other alternative lenders. That way there's somebody who is smart, is private, is risking private, not government-backed capital, to take the risks in these loans, and you're a lender to them, so it gives me liquidity, but you're not the first loss, and if there's a problem, you're not the one dealing with it. So that shift in the regulatory environment, starting in the great financial crisis in 2008, is now literally just bearing fruit starting in 2016, in terms of now there was a movement. It wasn't like people just woke up in 16 and said, okay, we're going to change behavior. You could watch this train coming for a long, long way away. And so people shifted their behavior to try to accommodate it. And then the other thing, frankly, during the prior administration, there wasn't really just a lot of transparency as to what they wanted, not being Democrat or Republican. Just the Obama administration just really wasn't that forthcoming of here's what the regulations means. You'd say, I got a regulation. Here's my strategy, does it work? And they just wouldn't answer the phone. So then you had to guess, and they said, look, but if it doesn't work, we promise we'll call you and you're in trouble. So in a way, it made everyone err to the conservative side. But as a result, most of these institutions that would have been competitors to us have shifted into lending to us or providing liquidity to us on a senior level.
And so I want to dig in on the construction loans, but before we do that, I mean, you've got such great experience on the CMBS side as well. Big picture, what's happened with CMBS since the beginnings of the pandemic? What do you see for CMBS in 2021?
Look, I think CMBS kind of has two sides to it. It's got we call the SASB, which is single asset, single borrower, which means that you do one big loan and you go out and you tranche it and you sell bonds on it. And I think that market is going to continue to be a very active market. CMBS has been used in the single asset market because it's just incredibly efficient. And people have gone to it. And generally it's the financing of kind of it's the second look financing for everyone else. If you can have a balance sheet lender, you generally would prefer to have a balance sheet lender, but CMBS has offered more leverage at a reasonable price to a wider set of assets than maybe bank lenders would, and certainly on the higher leverage side. And some things that aren't as favored at various times: student housing, sometimes mobile home parks, some retail, some certain hotels at higher leverage. The bad part about CMBS has always been its inflexibility. I'm on the board of CREFC. I work with a lot of people. When I was in the CMBS business, I worked harder at it, but there's a whole bunch of servicers and BPs, buyers, and other people and traders involved in that business that try to make it more flexible. But ultimately, it's a bond deal. You're not allowed to make decisions. That's the regulations, really. And so you're kind of locked in a box. And the knock on CMBS has always been things go wrong. One, does anyone even answer the phone? And two, are the decisions they make really in the best interest of the deal, or the best interest of the bondholders, the best interest, some would say the special servicers of just collecting fees to be, a servicer. And you all have all these conflicts, and it causes a lot of anxiety to borrowers, and it causes a lot of behavior. So I think if you looked at the balance sheet side, and I don't have the exact stats, the balance sheet side, as using hotels as a great proxy, see almost every balance sheet lender on their balance sheet hotel loans has kicked the can down the road for 3 months to 6 months. They basically said, we'll defer interest, we'll just accrue and add on your loan. If you have some reserves, that maybe we'll let you use some of the reserves, et cetera, whatever it is. we're not going to accelerate the loan for 6 months. I think the stat, and I could be wrong, is only like 40% of the CMBS loans that are in hotels have had any sort of deferral. So 60% of them are being, essentially not deferred. I'm not sure if they're accelerating. I'm not sure if they're foreclosing, but they all have to go to special servicing, which adds costs. Special servicing is not how to talk to you unless that happens. And then once that happens, you have these extra costs. Then they say, we may or may not help you. And it seems like to date, less than half have been helped. So I think CMBS, in terms of how they're handling the book of business, is going to be much more aggressive than balance sheet lenders. I think the CMBS market, the bank deals have come out. They're best deals. I forget the name brand, but they've come out. They've traded reasonably well. Rates, went from my AAAs, and again, I don't know the exact spot price today, but they were kind of in the 70s or 80s. They went up to 300 for a couple of days. Then the TALF came out, and they went back down to the 90s. So rates are normalized. There's always a pendulum in underwriting that people will be much more conservative. I think it's going to be very hard to put anything but a best-in-class hotel or retail asset into a CMBS deal. And people are scared of office too. So it's kind of like winning an election. You got to get everyone who you're selling to, the voters or bond buyers, to like your collateral. And it's hard from a cash flowing standpoint to probably find collateral that you can get enough people to like that you can put together a good deal.
So that gives us some idea of what's happening with the banks, with CMBS. One other segment of the market that I want to touch on before we talk about the construction lending piece, life companies, a relatively smaller share of the market than is the case for banks, certainly. How are they faring through all of this?
Look, I think if you talk to the brokers and if you look at some of the bids that we're getting on senior loans we're doing, I think life companies are probably the highlight of the market. I mean, there are certain asset classes, kind of big picture on COVID. I think COVID's taken everything and accelerated it, whatever it is. If, decisions in terms of, am I staying in New York City or am I going to leave? If I have kids that want to move to the suburb, am I going to buy a bigger apartment or not? And it's done that with asset classes. So some of the asset classes, which are just, you would think are going to be strong asset classes, have just grown stronger. So in the industrial asset class, is the pricing's as tight as it's ever been, maybe tighter. Maybe there's a teeny bit of movement because underlying rates are so low, but the bid for good quality, especially last mile industrial or class A, like clear ceiling heights industrial, that bid is as strong as ever. That's a lot of it's from life codes. Same is true in multis. The high rise multis in some of the major markets may be getting dinged. The San Francisco's, the New York's are losing a lot of vacancy, getting a lot of vacancy, and I think that's for a different reason. But I think if you go out to the suburbs and you look at the traditional garden apartments, you look at stuff in Brooklyn and Queens, and most of the suburbs, it's doing really well, and the life co bids on that are still really strong. So I think that you'll find that market really didn't take that much of a dip. Life co's traditionally are conservative. They pick their collateral, they price better than others, and as a result, they get their pick. And I think that's continuing. So life cos are in a very, very strong position. And my guess is with new allocations, depending on how those things work as asset class valuations move and their portfolio dynamics change, my guess is that real estate will be a good sector for them in 2021 as well.
Yeah. So before we talk about some of the deals that you've been working on during the pandemic, I remember, it wasn't honestly that long ago, sitting down with Marty and hearing a little bit about the first deal that you guys had worked on, and thinking to myself that you weren't just dipping your toe in the water. I mean, you started big, but tell us about your first deal.
I think that, well, it's interesting. The first deal is probably not the one you're thinking of, but we bought a piece of. I'm going to just step back a teeny bit. When I came here, the thought was, we've got this great secret sauce in the development team. Second thought was, Silverstein bids on a lot of deals and we lose a lot of deals. And like, they were buying one deal a year and they were bidding on maybe more than that. And the reason most of the deals we lost is we just didn't like the price. But the thought was, if there was a building down the street, Silverstein bid $1 billion for it, somebody else bid $1.1 billion. Okay, well, billion's about 92% of $1.1 billion. So if we have a debt platform and we would lend 800 million or 850 million, that feels a lot better than the $1 billion we'd pay to buy it. And if we can get a better return than maybe even on the $1 billion we pay to buy it, that feels even better. And that 80 or 800, $850 million loan on $1.1 billion is a pretty highly levered loan. But guess what? We already underwrote it and did it. So we thought there was going to be a lot of stuff that Silverstein looked at on the equity side that we just missed. We liked, but we just couldn't get there in the last dollar, that we love on the debt side. And we get more levered because we put our equity hat on and we're comfortable. So if you ratcheted that back on a debt on a current pay basis, we'd like. And so that was kind of like the second leg. And the third leg of the stool was just that I have a lot of relationships, Marty does, and we're going to see a lot of flow. But the first deal we did, we actually did a participation in a deal that Larry built in Times Square sometime in the 50s. It was a hotel in the 1950s. And then Silverstein got involved in potentially doing this mixed use project. I'm not going to name it. In Times Square, and we got involved. We got involved in the development side, and ultimately, and it's a multi-billion-dollar project. Ultimately, we just decided the complexity and the cost of the development was going to pose a bunch of risks, and we didn't love the equity returns. We would have built it, and our partner, our would-be partner, said, "Look, I want somebody on the construction side that's really side by side with me. I want somebody to put in equity." And they found somebody else, but we were deeply involved in the project. So the first deal we did was that project, a building that Larry built in the 50s, going up in Times Square. And we bought a piece of that deal. We bought it from a bank. We did it in a little bit of a structured way, but it was interesting. It had a lot of touches. You know, it was a bank relationship I had, and we took some leverage to make the deal interesting. It was a building that Larry built forever ago. It was a project our development team had worked on. You know, it was all pretty cool. And then ultimately, you know, one of the major banks hired us as their construction advisor because they said, "Wow, we've got this you know, crazy mixed use project with unbelievable stuff going on in it. And if something gets weird, you know, we have a great monitoring team, but I promise you guys, having been in this project, you know, built it and been in the project for forever, Larry literally knows where the trap door is and, you know, on B2 that connects one side to the other, and where the key is for it." They said, "We think you'll do a great job." So that was the first deal we bought. But the deal that I think you're talking about is we lent $235 million on a mixed-use tower in downtown Brooklyn. It's called 9 DeKalb, right in the corner of Fulton Street on the end of the Fulton Mall. It's going to be by far the tallest building in Brooklyn. Really shop architect, really beautiful design. Same architects that did Copper Building and also did Steinway Building. You know, not the crane operator for Steinway, but the same architect. And so anyway, so we really like the project. And what do we like about it? It mixed use. Yeah, do that call. Tall and complicated. Thought it was really interesting. We thought developer Michael Stern at JDS, really good builder, really strong developer, proven track record, some really complicated stuff. Sits on a bunch of subway lines. Are we used to public transportation? Yeah, guess what? The World Trade Center touches 17 different subway lines, probably the biggest connectivity of any place in the country. Had all sorts of tax abatements. Do we know about tax abatements? Sure. Larry owns 3,500 units on 42nd Street with tax abatements. We're doing a gigantic project in Astoria where we're repurposing, you know, 3 or 4 city blocks for a few million square feet. So all of the things that all the different groups in our organization know and understand, we're there. You know, the big condo component, we get that. Can we get Corcoran and Douglas Elliman or Elstead to give us incredible data because we're big consumers and hire, you know, do we hire them for our project? Sure. So we get incredible information from them. Multifamily market. We have lots of multifamilies. We're actually doing stuff up the street. So knew about that. You know, can't tell you we knew a ton about retail in Brooklyn, but that was a really small component of it. But anyway, all the components of it, cool building, sexy design, infill location, you know, super dense. And ultimately all of these things, when I think of markets or I think of projects, I think, would Larry Silverstein be proud to have his name, his picture next to this project? And that's one of my basic litmus tests. We're not doing, no offense to it, we're not doing horizontal development in the suburbs. We're not doing things that just Larry doesn't do. We're focused on urban markets, complicated, large scale, mixed use. And so anyway, so we did this project. We have a Canadian bank as a senior lender, you know, with a few, 400 plus million in front of us. And the project, you know, was in the ground when we started, and I think they're up to the 28th floor of it right now. I walked it the other day. It's doing great.
So tell me about what's happened during the pandemic. Have you retreated from the market to assess, given the degree of uncertainty, or have you capitalized on, you know, the opportunities that have opened as others have retreated?
Yeah, no, we're really fortunate. So we have really strong institutional backers. We've done deals both in essentially a fund structure that we set up when I first started. And then outside of the fund structure, really just for kind of either logistical or conflict reasons, not because anyone didn't like a deal that we pursued. But we had the benefit of being a new firm, right? And so somebody said, how's the cash flows of your deals? I said, well, they're all construction loans that are getting delivered in 3 years. So good news is they're the same as they were before. If you have no cash flow, you've got no cash flow to lose, kind of cheekily. But the truth is our stuff's meant for 2023, 2024. So the exact conditions of today's market don't impact us. Now, do COVID delays for construction impact us? Sure. Do they affect the budget of the projects? And we spent a lot of time, focusing on that? Absolutely. And just having Silverstein staff walk these projects and review the budgets as well as all the consultants and something that normally would have. Now, of course, so from a risk protection standpoint, we feel really covered. But we have sponsors. We have two of the top 10, sovereign wealths, I call it, in the world as our backers. So deeply liquid, the folks with a really long-term strategy, like a forever strategy. So we benefited from that. And so we used COVID as a real opportunity to shift the asset classes that we could be competitive in. So we were doing more highly levered deals at generally double-digit returns. And what we chose to do is to not keep that leverage point and get higher returns, but to shift our leverage point down and try to get the same returns. And surprisingly for us, actually better returns. So we were fortunate to have liquidity. We had a team. I joke, this sounds crazy, but we were the last group to come to Silverstein. And as I grew my team, we kind of filled in pockets around the office. We have a big trapezoid floor plate with a gigantic core, mainly office space. So people are all around the outside like a donut. And my team just took what was available. And we were in the process of reshifting everyone and moving between floors. We have a couple floors. But my team, no one could see each other or talk to each other except me and my assistant. No one was on. So we called, so I had no idea if anyone was in the office if I didn't call them. So I said we were uniquely prepared for COVID in that we never actually sat by each other. And so when COVID happened, a Zoom call was just like having somebody on the other side of the building. So our team we have great capital. Our team was used to working, I won't call it remotely, but used to working not in a bullpen together. And we jumped on the opportunity. And so we've done, I was thinking about it, I think we've done about 2.5 times more dollars of deals since COVID than we did in the year and a half that we were around pre-COVID. And the deals we were doing are much better. So we bought, and there a bunch of them have been liquidity. We started just buying loans. The mortgage REITs, smart people, great books generally. The ones that are in the lending business, many of them, they're also, especially ones that are in other businesses, many of them look at the debt business and say, hey, listen, all I can get is my money back. I've got incredible opportunities to go stuff in my equity business. I'd rather free up the capital. And if you think about it very simplistically, their mortgage REIT stocks were down by 50%, sometimes 70, even 80% at some point for some of them. And if you think about it, and you just say, okay, I've got $1 billion of assets, but the market's valuing that $500 million, okay, 50%. If I have a $100 million loan as part of that $1 billion of assets, even if I sell it for 90 million, I can go buy back my stock at 50 million. So I can buy back more than 100% of my stock. I buy 180% of my stock back relative to the valuation. So that's accretive to me. So we found the mortgage REITs are very interested in smartly. They're not fire selling, just for liquidity and market reasons, selling assets and using that capital to pursue other opportunities and buy back stock. So we bought a few $100 million of mortgages off of mortgage REITs, big, top tier mortgage REITs. And the deals we've done have been in New York City. And kind of the metrics have been, let's look at stuff at what we think is half a replacement cost. And we bought a deal at 700 a foot, condos, Class A building, Class A market, everything great, about to be finished, great sales, great sponsor, I mean, everything great. We bought at $700 a foot. They're selling for $1,500 a foot. They sold one in the last week, that price. And our returns on that, we think are 17%, right? And that's versus getting 13% on a mezz, and that's on a whole loan. We bought another deal recently, that was a couple $100 million. So we bought that deal in March. We signed it up in March, we closed in April. So we literally were one of the first people to do a major transaction at the beginning of COVID. And then over the summer, we chased a couple rescue capital deals we didn't get. We tried to do Century City in LA and provide 300 or 400 million of rescue capital. We got beat out by the Reuben brothers out of London, one of the highest net worth families who is diving into the U.S. in kind of the same way we're interested. But we chased some deals, and then we bought some other loans for mortgage REITs at the end of the summer. And what we've done is we've said on stuff we're buying, we want to be high returns at a discount, well below replacement cost. And then we've also branched out into other markets that are doing really well. And you may not think of sitting in New York, or I'm not sure where all your NYU students or professionals on this call are sitting, but there's some markets that are really, really hot. So Austin, Texas is a great example. I went down, we're doing a project in Austin, Texas. We hope to fund it in the next few weeks. Ground up construction. So by definition, we're not lending 100% of the money, but the project's being done at replacement cost. The person's building it right now. Why do we like Austin? Well, we went down there. It's got some condos in here. We went to the first building I went to. We walked in. I just said, hey, look, I'm thinking about spending some time here. I want to know about condos. How you doing in sales? Sold 10 units a month, every month for the last 3 months. This is a couple of weeks ago. I said, really, who's buying them? New Yorkers, people from Chicago, people from California. I said, investors? Nope. People are moving from high tax states to Austin. We're psyched about it. Tons of tech jobs, right? Google's building the tallest building in Austin. Facebook just finished the building. Apple's opening a campus there. I mean, Amazon's opening a campus. All the tech, the TAMI tenants are moving there. So we look at that market, and a building got opened, 150 units. They sold 40% of it in the first 3 weeks, not with real deposits, not speculators. So some markets are actually doing well. Austin's the #1 in employment growth, which means they've lost the fewest jobs, but they were down like 2% of jobs as of last month. And it wouldn't surprise me if this month they're actually net positive. So we're finding markets that are really hot, and we're investing in new construction. And I'll just do one more to Sam, then I'll ask you next question. Bellevue, Washington. Since COVID, we signed up a deal in Bellevue, gigantic mixed-use project, under $1 billion, but not by a lot. And Bellevue, Washington, since COVID, Amazon said we need to expand from Seattle. They already had HQ2 in DC. Everyone competed for it. 25,000 jobs. New York had it, lost it. 25,000 jobs. Since COVID, Amazon's announced that they're moving 25,000 jobs to Bellevue, Washington. So the same as HQ2, they're moving literally across the Puget Sound. They're doing it because there's a new bridge that's getting, a new train that's going there. It's super pro-business. It's low tax. Amazon's getting taxed like crazy in Seattle, and it's close to their other headquarters. Then Facebook announced 5,000 jobs, and Microsoft announced 5,000 jobs. Google announced some jobs. And so in this little market, in the last 8 or 9 months, 40,000 jobs have been announced. It's a 10 million square foot office market. They're adding 10 million square feet of inventory over the next 3 or 4 years. It's 100% leased. So we like that market. And you think, wow, how can a market be that good during COVID? But some of these markets are, and some of these tenants, which you think they're never coming back to office space, they're taking down gigantic chunks of office space. They're committing in 2 or 3 years. Our people, maybe not 100% of them, but 50, 60, 70% are going to be back in the office at some point for some part of their week.
Yeah, so I want to ask you about the competitive position of these markets. Some of the things that, at the Urban Lab at NYU we're looking at that are driving growth in some of these markets are also things that present potential headwinds for New York, the high tax jurisdiction, challenges around infrastructure, funding of the subway system, and light rail. You and I are both big believers in New York City. Want to get your sense of how it is that we'll navigate some of those challenges over the next couple of years. Before we do that, since you're talking about sort of this office demand boom in Bellevue, Silverstein was one of the first to go back to the office to say, look, we've deployed technologies and processes that that have allowed us to come back, to be effective, right, to be safe. People, we don't have community transmission in the workplace. Folks might get it sort of over the weekend. And you've really shown that it can be done. What's your overall prognosis for the office sector, and what the balance will look like between being at work, which I believe in, and I think it's so important, particularly for young people. Your company may give you the opportunity to work remotely indefinitely. You're particularly in real estate. You're not going to develop the relationships, the trust relationships, the networks that you need to really propel your career forward and build momentum if you're not coming into the office and meeting people and getting to know them. But Michael, what are your thoughts on what the balance will look like? You know, what role will play?
So I lost you. It was a long question. I think I can answer it a bunch of ways, and I lost you at the very end. But that said, look, I'll attack it a couple ways. I'm saying this jokingly, but Marty Berger, our CEO, runs a ski trip every year. And last year there were 130 people on it, and 75 of us got COVID at the beginning of March last year. We were in Vail. There was an international burden ski competition. A bunch of Australians came with COVID. It's been wildfire through Vail and Aspen, and a huge chunk of us got it. So Marty not only is a leader in getting people back to the office, but he's also a leader in creating antibodies in his staff. So fortunately, all of us were fine. I lost a great uncle to it, so I understand the impact it can have. But fortunately, we were all fine. But I think we come to the office, I think with a little bit more insight maybe than some, maybe a little less fear because we got through it. But there's no question that as we brought people back to the office, the thoughts that you have on safety, on transportation, on a number of issues really are tough to grapple with. That said, the 400 people we have here, we thought the way to do it was to set up essentially a committee headed by our HR person. So if somebody said, look, I'm not comfortable, they would go to that committee. They wouldn't have to go to their boss and explain it. You wouldn't have differing standards on why you come or don't come. And that committee, was very liberal in terms of granting people that they thought had legitimate reasons for not wanting to come, whatever they were, not to come. And only 8 people in our organization said, look, I really don't feel comfortable coming to the office. So I thought that was great. All the real estate companies, and SL Green probably was the leader, but Vornado, SL Green, Related, us, Brookfield, have tried to lead the way in bringing people back to the office. So we had voluntary coming back to the office starting in June or July, whenever it was allowed by the city and state. I came a couple days a week just because I find myself more efficient. Most people did. And ultimately on Labor Day, we said, you got to come back. Unless you have a reason not to. We did it with a lot of thought. If you're in an office, you're socially distanced. We put in the filters. Everyone wears the masks. Everything's sanitized. We have tape on everything. What conference rooms, most of the chairs pulled out. All the things you'd expect. If you're in a cube, the way our office is laid out, they set people every other cube. So you're 6 feet apart because they're big space cubes. So if if the cubes go 1, 2, 3, 4, 1 and 3 come in Monday, Tuesday, and 2 and 4 come in Wednesday, Thursday. But we have most of our staff back in the office, and it's been great. It's been absolutely great. Having in-person meetings, having the moment after the time in the boardroom to talk to somebody about something, doing things face to face, talking. It's just the interactive, the creativity, all the things that when you listen to CEOs talk about what's missing by not working from home, we're getting back. Flip side is, look, you get a lot of time. You save a lot of time when you're not commuting. And I noticed that time, and there are plenty of times I were really happy to take calls in pajamas, right? Yes, but Zoom was maybe one of the equalizers because people couldn't just, they had to actually wash their face before they showed up at work. But look, we're successful in people coming in. It's been a real help to our productivity and organization. That said, we have a dashboard for our building, so I look periodically at how occupied we were. A couple of weeks ago, I looked at this building where I'm sitting right now, 7 World Trade. It's 2.6 million square feet. I think it's 53 floors. And there were 154 people in the building. 75 were from Silverstein and 79 were from the other 2,550,000 square feet. So it averaged just over 1 person per floor of the skyscraper. So most other people aren't coming back. On our Midtown buildings, which are more kind of fashion, lawyers, we're seeing much higher occupancy, but even the peaks is kind of like 10, 12%. When I say occupancy, I'm talking about the number of people with swipe cards that actually show up in the office. Our actual occupancy in our portfolio is great in terms of tenants paying rent, and the pay rate's incredible. We're getting we averaged 97% pay before, we're getting 97% pay now. At the beginning, we actually got higher pay receivables just because we were focused on calling people to see how they were doing, and so they paid more quickly by a percent or two. So being in the office has been great, but you have all these issues. Ultimately, I think it comes down to childcare. If your kids aren't in school, then you got to deal with your kids, and parents, either for real reasons, sometimes just because it's convenient, say, look, I got to deal with my kids. And until I can deal with my kids, I'm not coming back to the office. I'm not coming back to the city. I'm not coming back to my apartment. I'm just not going there. And I'm going to live a different life for my children that's more socially distant. Yeah. I was fortunate enough to be able to live in the Hamptons for the summer. It was awesome. In a big house, lots of space. We weren't crammed up in my apartment in the city. And I think until you have that need to be someplace, which is really grounded by children, and then once people with children are there, then other people have to be there too. That you're not going to see people coming back, in a material way to the office. And obviously, what you're seeing now with the resurgence of COVID, recently in the fall, as you would expect, that's in the closing, I think, of New York City schools, et cetera. I think that's going to push people away. Um, I think what if I were to had to pick a couple trends, people are going to want to come to work. They've been talking about it forever. When the internet came out, people were all going to sit at home. No one needed an office. It's BS. Um, I think offices are going to become, from a layout perspective, more flexible. I think leases are going to become more flexible. So the office physical space, it's going to be more rooms where you can change things around and people can come and go and shift. If you talk to the tech tenants, they say that the office space they have is going to be a massive part of their HR move. How people perceive their buildings and their space is going to be a huge thing, be it being a modern building with clean air. And also when you get people together, it's more of an event because people aren't going to always be in the office. So when they're there, they want it to be a clean, state-of-the-art, modern place. And if you have that, that's a driving way of hiring people. And the tech tenants are all coming in big time and taking down space. So, and those are the ones that you would think would be the easiest to commute from home. At the same time, they're saying, you're not coming until next summer. They're signing up massive leases. Now, there's certain markets, San Francisco, where they already had a ton of space. Maybe they're not signing as many, but they're still in the places that they're growing, especially some of the lower cost places. They're growing in a big, big way.
Yeah, and two things I'd like to add there. First, when I mentioned earlier, young folks, think carefully about that opportunity to work remotely indefinitely. I
Yeah.
certainly don't mean to suggest that you should rush back into your office in a way that may be inconsistent with your, company's policy or guidance from your local or state government. Do everything safely.
Yeah.
The particularly now, as we do see those numbers going up, as Michael mentioned, long term. We all look forward to that day when we have a highly effective vaccine that's also been widely deployed. Long term for your career, take advantage of the opportunity to go in, meet people, build relationships. That, especially in real estate, it's so important for how you think about the future direction of your career over the longer term. Michael, the point you raised about New York City schools have just closed again. I think today is the first day that we're back online for New York City public school system. One of the other things that we're looking at the Urban Lab, and as a focus for me, is that even once you control for differences in skill levels, we're seeing a disproportionate impact of the childcare issue that you raised on women in the labor force. More of the childcare burden, is falling on women heads of household, and it's impacting people's ability to re-engage. It's a very, very real issue where we're seeing divergence in outcomes across men and women in the labor force. Not everyone is able to easily and cost effectively identify alternative schooling alternatives or care alternatives for their kids when they're not going to school every day. So we have just a couple of minutes left. I appreciate your time so much. Where are we going to be in a year?
Look, I think, look, I'm an optimist, and I think we're going to be in a good place in a year. I think there's going to be a vaccine. I think the vaccine is going to make a big difference. So my whole team, as I said, we had COVID. I tried to donate antibodies at Stony Brook University to folks that were sick. I had the 78th percentile of antibodies, which is great. But so many people on Long Island had antibodies that they were taking people, harvesting for people with 82% off. So I didn't give, but I knew how many I had. And I've been tested every other month since, and my antibodies haven't gone down. So I know they say they may go down. For some people, they might. But to me, that's good news. And my whole team has been tested the same way, and they've had the same experience. So I think, I find a lot of the people that are, I'm going to say something political here, that don't want to take the vaccine or don't think anybody's worked. Same people that, are believe in environmental issues, that, are very, believe in global warming. So you got to believe in science. They go, except for the vaccine. And I think that's crazy. Vaccines work. There's a reason polio is eradicated. People should take the vaccine if you're comfortable with it. And I think a lot of people will, especially when they realize it, once they've determined it's safe. Vaccine is going to be a game changer. I think that people are going to come back to work. Okay. People want to be in cities, But I have this theory with cities like San Francisco and New York specifically, but a lot of them are like it. The cost of living in New York is so high. Your quality of life in terms of your apartment is so low. The ease of moving in and out, or the financial ease of moving out of an apartment in New York when you're paying thousands of dollars a month in rent, the cost of putting yourself in storage or doing something or traveling. It's so easy to move out of these cities. And when you're in a city and no one's going to the office and you're in a tiny apartment compared to what you could get someplace else, and the restaurants are all closed and the stores are boarded up, people in these cities, the reason they got to the cities, they're smart, motivated, people that move with their feet. So they've all moved out. And I think when the world comes back and you can operate safely together, these same people that want to be social, that want to be near work, that want to see art, that want to have parties, that want to eat the best food, that want to hear the best music, they're going to come back to New York. They're going to come back in a big way. And just as easy as to move out, it's going to be just as easy as to move back in. It's going to take time. 21 at the end of the year, we're not going to be having Christmas parties saying we're back. It's going to take a couple years. But I think you're crazy if you think people don't want to spend time together and want to do Thanksgiving over Zoom. I think it's nuts. And so I think the world will come back. Do not bet against the big cities.
That is a perfect and very optimistic, as you said, point at which to wrap up. Big believer in your prognosis. Michael, thank you so much for your time today and for the work that you and the team are doing. Happy Thanksgiving to everyone. Please, stay safe, stay healthy, and we will see you again as part of this series right after the break. Thanks, Michael.
Thanks, Sam. Thanks, everyone.
Bye.